The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. My name is Megan Cox. I'm the Marketing Events Manager at Curinos. Thank you for joining us for today's webinar. You get what you measure, adjusting prospecting KPIs for success in the new consumer deposit market. As the industry's leading provider of data analytics and technologies, we are here to help you better attract, retain, and grow more profitable customer relationships for your financial institution. If you have questions during the presentation, please type them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send the recording and the deck to you via email post-webinar. Okay, Hank, let's begin.
Thank you, everybody, for joining us on this Wednesday afternoon to talk about all exciting things like data and analytics around marketing. I have Laura Hanley joining us from Synovus. Laura, would you like to introduce yourself?
Hi, everyone. Hank, thanks for having me. I am from Synovus, which is a regional bank in the Southeast. We're about $60 billion in assets, and I'm the head of marketing of a team of about 50 people.
Super. What we thought we would do today is kind of go through and set the context of the stage for deposit acquisition as it stands in the market today. We were going to go through and talk about different measures of success that different organizations that we work with have leveraged, and the strengths and weaknesses of those different measures. And then what's even more important, I think, and more interesting for the crowd on the phone is playing through how those measures change depending on the marketing levers that you pull in acquisition. So with that said, I'm going to get going because I know that we have an exciting agenda, and off we go. The challenge that we're seeing in the market today is really fourfold. Number one, marketing costs since pre-pandemic have roughly doubled, if not more so, on deposit acquisition. The second challenge that we're observing is the average value of a customer is declining, and that's both due to marketing in terms of the revenue being generated from fees such as overdraft and debit interchange and the like, but also as a result of improved targeting from other organizations creating adverse selection. So the average value of a customer is declining as we go through. One of the observations that we have looking at this is looking at regional and community banks and their ability not only to have the analytic teams to evaluate this data, but also have enough data to evaluate, to make improved decisionings around who they're targeting and how they engage with those customers. And in the last challenge or complication is a lot of providers in the marketing space are incented to drive volume of marketing rather than the value of marketing. And what we hope to do is present tools and tricks and opportunities to optimize that. Laura, do these issues ring true for your organization, or are there others that we've left off in the current market landscape?
I absolutely agree with all of these. I wouldn't necessarily add any additional ones, but I would say I think the pressure to react with speed is huge with decreasing budgets. And then there's a lot of risk management that goes with this. So the more sophisticated we get with data, the more overhead we have with our risk partners. So those are just some of the additional pressures, I think, in the landscape on all of us.
That makes sense. Based on Curinos data, we've been tracking market acquisition and what contributes to it for the last 10 years as an organization. One of the things that strikes us is marketing as a contributor to your acquisition is representing more and more. So the way to read this chart, working from left to right, is in 2015, marketing represented roughly 25% of the reason why a particular consumer would choose your institution. Branches, in contrast, represented nearly 60%. In today's world, and the trend continues through 2024, marketing is representing a disproportionate amount of the reason why a customer chooses your institution, with branches and your network representing less and less. What this chart is also illustrating is if we look at primary account acquisition since 2015, network banks that had branches represented roughly 93% of the acquisition. In today's world, they're vying for roughly 40 or 53% of the acquisition. So the share available to these network banks is declining. In contrast, and we started to talk about this on the first page, is the cost per account or cost per acquisition is going up. If we look at CPAs since 2018, those numbers have more than doubled and are continuing to rise. And that's a lot to do with competition. More organizations are spending more money. As a result, it's kind of like a mutually assured destruction arms race in marketing to spend money to have share of voice to acquire the customers that you need. Just out of curiosity, Laura, has your budget increased by 150% over the last 6 years?
It's probably decreased by 30% over the last few years. It's a pretty shocking number now.
And I think a lot of regional organizations are struggling to, do these trade-offs. It's more expensive. We have to be marketing, but we have less to work with. Where should we spend, and how should we spend those dollars? Any other thoughts?
I would say the one implication here for us is that you can't look at your growth marketing and your brand marketing as two different beasts, and you have to think about how you're using those lower funnel tactics that may have been dedicated to the direct marketing to also build the brand. And then the other element here is we're obviously part of a bigger picture. So how are we collaborating with the consumer bank, which in our company also owns the digital experience, so that all of these things are represented and we're making decisions together.
That makes a ton of sense. One of the observations that we have is both tracking the consumers that are in motion and creating new primary financial institutions on the deposit side, as well as the amount expended. And what we're seeing is literally in the US, there's billions of dollars chasing millions of customers. And if we take this at an overall market level, what we're seeing is the average CPA across the market, and this is just cost for marketing, not for incentives and your marketing organization. This is literally just the amount that you're spending on mail and EM and digital ads and the like over the acquisition. We're seeing an average CPA of $520, which is remarkable. Now, the interesting thing is if I take out that 47% that's going to digital and direct banks that we kind of showed on the last page, that makes this number closer to $1,000 on average. And what's really interesting is how different organizations perceive this number as we go through. And so that's one of the reasons, one of the impetuses for this webinar is to talk about how do we measure this so that we're all using the same terms the same way so that we can be excellent consumers of marketing and marketing analytics, but also how to improve those measures. Certainly, Laura, I'm guessing that you felt the impact of more organizations in the market to grab your customers and trying to see how your impressions and your outreach, how has that really impacted the response rates that you've gotten? Have you noticed a difference, or is it kind of same for same?
It definitely depends on our market, and I think we'll talk about that a little bit later. I think we probably hear about it more from our team members than anybody else because they're watching the volume of people that come into the branch, and so they're clamoring for more marketing, push them in. I think the other thing for us is we are just so targeted in our spend. You know, we do not do broadcast media in any way. We don't do radio. We're not doing a lot of out of home. We are very much looking at those more efficient channels and how we spend our dollars.
That makes a ton of sense. So I'm going to go to a poll and have Megan throw up the poll for a second. We're going to ask you guys, how do you measure, what is the critical metric that you're using today for the success of your campaigns? And we'll track the results. Laura, just out of curiosity, what measures do you use, or is it a combination of measures as you think about the effectiveness of your programs?
I would probably be checking other here. Cost per deposit is a recent metric that's come up for us in the past year as we're looking really at deposit balances. So that was a new one that we've been working with finance on. How do you calculate that cost per deposit of a campaign?
All right. It seems like what we're seeing in the responses, a majority of organizations are leveraging cost per acquisition, or CPA. A few, or the next highest, is return on marketing investment on 5-year, and we'll talk about some of these. And few are using cost per balance acquired or some other measure as we go through, which is interesting and may actually set up our conversation. Thank you, Megan, for turning off the poll. We'll go on. What we thought we'd do is just spend a little bit of time comparing these measures and what's really been done. What's really interesting to me, you know, as a vendor or a supporter, a friender in the industry with Laura here, is cost per acquisition really came from the consumer packaged goods industry, where the value of what we were selling is constant, meaning if I sell a widget and it's worth $100 to the organization, CPA matters a lot. When you think about CPA in terms of the ways that you've been using it, Laura, does CPA, I mean, it seems to me like you could get a customer that actually costs you money, or one that makes you, you know, $5,000 a year. How does CPA help you track that? What do you hope to get out of CPA?
With CPA, I think, you know, it's definitely about optimization, and are we optimizing the different channels? I think we've seen a decrease in our paid search spend, for example, because we can't match those CPAs to some of the other more direct channels that we use. But I would say at the end of the day, when we're having conversations outside of marketing, we don't get very far with CPA. It's just not something that they find believable or that speaks to the true business outcome of what the campaign drove.
And I think that that's consistent. I think the reason why it's stuck around so long in the industry is it's really easy to measure. I take my total costs and I look at the customers that open new accounts with my organization. And so pretty soon after, within 45 days of a campaign or an outreach, I kind of really know what that number is. One of the things that it assumes, though, and we're kind of getting at that, is that every customer has the same value. And that's one of the things that's fundamentally changing in the market as we move forward. Some of the challenges is underlying CPA is that assumption, and we really need to avoid that. The next measure that we've heard and see through the industry, and again, each organization has slightly different flavors of these numbers. So we've tried to say how we were calculating it for this presentation. Cost per funded or activated account, and these can be very different. Some organizations measure it, did the customer put dollars in the account? Well, for some FIs, in order to open the account, they have to put dollars in it. So that number tends to be 100% of whoever opened. For other organizations, customers can fund later, and or the funding is considered with the first regular deposit or check deposit as we go through. So it's really looking at the customer having taken some action to leverage that account. The other thing is incentives are tied to this funded or activation measure as we go through in many cases. So it's a measurement of, did they do some debit transactions? Did they do things like that, which are more correlated with the account sticking and having value. So again, I think this measure aligns more with customer value. And again, it's still relatively easy to capture because I can count the accounts that actually do these things. One of the things on the other side that we've observed is it still assumes that every funded account is worth roughly the same amount as we try to express the value of this. Has Synovus leveraged this in some of their campaigns, or do they focus further down the funnel that we're about to go through?
We're trying to focus further down the funnel. It's very hard sometimes to get all the way, but I would say we look at this maybe some more on our digital channel, like our online account origination versus in-branch origination. So kind of looking at the quality of the accounts we're bringing in. And then we're real sticklers around our incentives and what we require you to do to come in. So we definitely look at that when we're thinking about those incentives that we're offering.
That makes that aligns with both what I know about you, but also where this is headed. One of the observations that we have in most of the acquisitions that are going on in the market is that anywhere from 30 to 50% of the customers that actually open and even potentially fund no longer exist at day 180 or 6 months later, because they haven't fully activated their direct deposit account. They haven't purchased other products or other solutions. And so some organizations were beginning to build out models that are looking to that 180-day mark. That tends to be what we would call the seat of the attrition curve post-acquisition. So it is a really good spot, because those are generally the ones that you're going to retain the value on. And this probably is the tightest measure to direct value that those customers have as we go through. It doesn't necessarily assess the value of the acquired relationship. I could still be active and primary 6 months later. That's one of the challenges with it. But the other thing is, and I'll call it short attention span theater, is that it takes 6 months to measure this, because we need to look 6 months later. What are some of the challenges that you have as you look further down the funnel, Laura, in terms of the measurements schemes that you've used?
We are not great at attribution yet. So the longer someone's been with the bank, or there's potential they were touched by multiple channels coming into the bank, we have not figured that out. And that's a data challenge. That's, about having a place where we can tag everyone and know exactly what was that mix that they received. So we have to focus really on the believability of a lot of our metrics. Finance is a hard judge, and it needs to be very believable and exact in a lot of ways. And so some of these get very fuzzy as you keep going further and further down the lifespan of the client.
That makes sense to me. We've used cost per balance acquired as a direct value of the account. And again, looking at this roughly at 6 months, so cost per retained deposit dollar, in terms of it works as well on the checking side as it does on the other side. It more directly aligns with the value of the customer. It is, again, longer to assess in terms of that. Obviously, the last one on the list is probably one that our finance areas love the most, which is return on the marketing investment, which is really looking at a longer term view of what's that customer worth. And again, I think it's very accurate to the value. I spent $100 to acquire a customer that's worth $500 a year. That's always going to come out as a positive ROMI. I spent $1,000 to acquire a customer that's worth $280 a year. Not so positive as we go through. The one thing that I've observed in the market is that organizations that purely use ROMI as a measure stop experimenting with acquisition, because it's hard to defend when we do a lot of testing and the like. And so it becomes a strange. Laura, as you talk to different stakeholders in the bank, do you tend to use multiple of these metrics, or do you tend to focus in on one or two of them that the organization's accepted?
We've been asked to really focus in on the cost per deposit recently. The real reason you have these KPIs or these metrics is so that you can make decisions. And so when we're thinking about, are we going out with a checking account offer that we want to drive balances with, or accounts with, versus do we need to go out with something like CDs or money markets that offer an interest rate, or do we want to do interest rate versus cash? I think that's where it gets a lot more sophisticated, and our partners want to know, well, which one is going to drive the greatest deposits at the lowest cost, because the deposits really ties it to the business outcome that they're interested in. We look at ROI on things. That is an area that finance has really been coming in and looking at with us, because that also requires understanding the profitability. of the products and those products over time. And our finance team has dug in and been showing us some different ways that they would partner with us on something like this.
That makes a ton of sense. I'm sorry, I'm trying to make sure I only advance one page. There's obviously other factors that weigh in on the performance of a campaign and the measurement thereof as we go through. One of the things that we've observed as we've worked with different organizations across the industry is this average versus actual. In some organizations, finance has come up with what the value of an acquired account is, and that tends to be backward looking. In some organizations, it can be backward looking 1, 2, 3 years in terms of that. And it's a fixed value. So if I get an account, I get $500 or something along those lines. And that's what's driving the average. The actuals obviously require a pretty flexible system to be able to understand what the underlying contribution of those things are. But we think is actually more important in the current environment. What we're observing is just like credit cards, there's a certain amount of adverse selection where organizations are targeting the cream and the best of those customers, leaving more and more of the less valuable customers as we go through. So if I'm relying on or being incented on an average, that the underlying data is changing or the underlying environment is changing, I might be making a bad decision. So understanding, moving from that average backward looking to the actuals forward looking or more recent is kind of critical. Market position matters a lot too. What we've observed is organizations that tend to be, most of their deposits are being acquired in markets that they don't have dominant share, are trying to compare themselves to organizations who have dominant share. And there's as much as 100% difference in cost and acquisition when I'm a dominant share player in a market versus a smaller share player. And Laura, we'll talk about this in a little bit with you guys, because a lot of your deposits are coming from markets that you're a smaller player in. And while you have pricing power in some markets, that's not necessarily what you need to do to drive success. The other issue that comes up a lot is this marginal versus total acquisition. This one's one that finance loves, right? Which is, if I don't do any marketing whatsoever, I can probably get 50 customers to walk in the door. And then when you spend a bunch of money, marketing person, and Laura, I'm not calling you out here. Let's say I spend $1,000 and I get 50 more customers. They want to divide through by those incremental customers, not by the ones that they could have gotten otherwise. And that really blows up the cost of this. And again, these measures are meant to help you make decisions, not to make decisions with the measures. And so I think that that's one of the things that we need to educate organizations on. And we'll try to help you through this presentation understand how different levers pull to change the outcomes on some of these topics as we go through. Test versus control is another set of issues. We hear this a lot, and it sometimes gets mixed up with marginal versus total acquisition. What we're talking about in test versus control is, hey, I have a marketing solution today that I'm using, and I have a new one that I'm trying to use. Which one's more efficient? And that's where, even if it's just marginally better, it makes sense to move to the new solution because I'm getting more efficient as we go through. It's a different conversation than marginal cost as we go through. The last one, and Laura, I really appreciate you pointing this out to me yesterday when we were preparing for this session, is really acquisition's a team sport. And we've observed at a number of institutions where marketing's being told to accomplish one set of objectives, the network's being told to solve for another set of objectives, and finance has a third set of objectives that might be what they're kind of grading everything on. Talk to me about that from your perspective in terms of how you get everybody on one page to drive success in these campaigns.
So first, I think we cheated a little bit and we reported to the head of the consumer bank for a while. So you have no choice but to collaborate when you're all sitting around a table, and it's required to do it. But hopefully now we're separated again, that collaboration continues. But we can't make decisions in a vacuum. So the goals of the consumer bank need to be the ones that we adapt, and then we have our marketing goals that align to them. We're on a journey. We haven't done when you think about the history of our company, we haven't done acquisition marketing for a long time. That's a story for another day. But we're working with finance on what do we need to be going after? How should we be measuring the campaigns? The product team is helping us with what are the incentives? What is a profitable offer going to be? We've got a new role where it's how are we helping get the branches ready for that go-to-market piece so that they know what's happening and what they're talking about. Some of the areas we're going to dig deeper into are understanding what are the branch goals and how are they set. And are we triangulating using what we know from places like Curinos against what they're doing? Because we all come at it with a different lens and some different tools, and can collectively decide what are those best tactics, what are the best goals to set and things like that.
And I would also think that different regions, you're running into challenges because everybody wants to be successful and drive growth inside the organization. But unfortunately, if we take marketing dollars and spread them like peanut butter, that might not be the most efficient use. And so is that also a challenge, is that you have some markets that are feeling a little bit starved and frustrated and try to leverage offers?
I think all of the markets probably feel a little starved. We talked about my shrinking budget, but I think so. We are a very geographic oriented company. That's the legacy of who we are, is these local decision makers and local banks. I think in addition to the frontline retail bankers, we also have considerations around how is the retail marketing strategy interacting with what the commercial strategy is or the wealth strategy, because we really believe about banking the full relationship. So there are markets that may want more marketing dollars invested, but maybe the primary reason for our being in that market is actually that commercial or that wealth space. And so that branch presence and that brand presence is important, but the direct marketing may not be. So we take a lot of comments and questions and feedback on that. Absolutely.
Well, it sounds like you handle that challenge very well as we go through. We're going to come to another poll now. Hopefully, Megan will put it up on the screen. You've heard about the different measures. The question that we have to you guys is, what has the biggest impact on net acquisition value? Is it the type of market that you're in, the outreach volume that you're throwing out there in terms of direct marketing, the targeting and customer mix, the amount of incentives you have, or the primacy or onboarded rate that you achieve? What's going to drive the greatest value change in your campaigns? We'll see if anybody else votes. We're only 27% there. Come on, take on the challenge. All right, it seems like that slowed down. It seems like targeting and customer mix is the family favorite, followed by, in equal order, primacy rate and market type in terms of these. Great call outs in terms of that. I think all of these play a role, and what we hope to do as we go through the rest of this, Megan, if you can turn off the poll. There we go, and we're back. What we thought we would do is kind of go through what we're observing in different markets and the like. And so, Laura, I promised you'd have the chance to talk about how you've become the thin growing market queen of acquisition in the Southeast. Your primary market was obviously the Heritage Columbus Bank and Trust. And you dominated in that market, and that's sitting in a really great space as a dominant share and the like. The rest and a bulk of your deposits are then spread across the Southeast a little bit more, with Atlanta being a very large market for you. But again, there's other large players there that are holding your share down. How does that affect how you go to market?
This was sobering, Hank, seeing my bubbles. And we are obviously in very thin markets. Again, I just mentioned it before. We do think about the branch presence. We think about the role of the branch in that market, whether it's there purely for retail or if it's playing some role for our commercial or our wealth offerings. Then also, you know, where do we think we have the opportunity for that full relationship? We also look at the cost of the media in the market. We recently acquired a few years ago a market in South Florida, and I went, oh my gosh, of course we bought in the Miami market, which is some of the most expensive media you can buy in the country. But I think one thing for us is I often feel like we're going to become masters of finding the needle in the haystack. So the thin market, it can be daunting, but we do have people that we can target. So it really becomes about that individual personalized brand building and then acquisition versus thinking just in terms of those geographic limits. So how pinpointed can we be? Can we get the right offer? And then we also are very relationship focused in terms of our product set. So that incentive is important, and we'll talk about it later because we need to get them in the bank to explain the product. We can't explain it in just a postcard. So those are some of the things that we're thinking about with this, but the pressure is on with this to really get those people into the branch. For us, we aren't focusing as much on the mass market, and so we don't need the volume, which is another factor with that targeting and how the targeting helps us really get in front of the right people.
That makes a ton of sense. And again, just for everyone's benefit, as we kind of look north-south on this chart, what we've observed in the market is that organizations that have achieved 8% market share or greater have kind of a halo effect inside that market in terms of acquisition. It's not to say that this isn't a continuous scale. We've kind of placed a bet on it. More importantly, what we've observed is that being in markets that are growing, or similarly important, is being in markets that are growing. It's easier to grow when the market is growing because you're getting a share of the new customers that are coming into that market versus markets that are shrinking, where the number one cause of attrition is probably death in many cases. And I say that half jokingly, but also half knowing the markets that are shrinking in terms of that. So the good news on the Synovus front, if I look at this chart, very few markets are shrinking. All of the markets that you're going after have huge growth. So it's actually a tailwind from that perspective. And you guys have been able to leverage that. Obviously, the only way to get to the top right in this chart is from the bottom right. So it's about growing share and getting up to the top right as times go on. And I think that even since I've been working with Synovus, if I look at these bubbles, they're migrating north. So it's definitely not to the right story as we go.
Yeah, and I think when you look at Columbus here, that is where we get the best response rates. But I will not win an argument to pour more money into Columbus. That's our home market. That's not an argument that will win. And then some of the programs to take advantage of that population growth and the expanding markets is the new mover triggers. We do that, and new business triggers as well. So that's kind of how we tap into that growth.
And that makes a ton of sense as we go through. The next lever that we talked about is the mix. And so hot off the presses is our shopper research for 2025. What you're seeing left to right is our segmentation. And again, it's somewhat simplified so everybody can play along on the home board here as we go through. Paycheck to paycheck customers generally are ones that I have identified that they have less than 1 month savings. 1 month salary in savings, easy for me to say. In terms of that, stable mass market are consumers that make less than $100,000 and have more than 1 month in savings. And then we kind of break affluent into people under 35 and people over 35. What's really important here is two things. If you look down at the very bottom of this chart, I think there's some key information that everybody can benefit from. On the primary value, what we listed out is the average deposits and loans that customer is going to bring if they consolidate at a single institution, at your institution. The revenue number that's presented here is an estimate based on spreads, average spreads, and debit usage based on these segments. So you can kind of see hey, a paycheck to paycheck customer is worth about $280 a year, and an affluent customer is roughly worth $6,100. Is every affluent customer worth $6,100? No, we've oversimplified this so we could have the conversation. But bottom line is the mix of these customers are very different as we go from market to market, but are also changing. If I stay focused in on stable mass market and above, that's that many fewer that someone else or another competitor can get. And as a result, the mix for a competitor going out with a generic message or an untargeted message will skew towards paycheck to paycheck. And so as a result, the value of that acquisition will go down. So it's really, really important not only to track who we're targeting, but what we're getting on the backside to understand what that mix is, because that's really going to change how we go through. Now, you mentioned, Laura, that you guys are kind of focusing more on the affluent, the Henrys and above, if you will, as we go through. And your product set, you mentioned something about your product set being kind of targeted for that space. Does that make life easier or harder for you, or requires you to be targeted, or any of those?
It definitely requires you to think differently. So like many, we had free checking, and we've just had to roll back on free checking. And when you're thinking about free checking, it's not that we don't think about the quality of those accounts, but the volume is very, very important. So as we shift our mindset to think about going further up that affluent spectrum, it really is, well, we don't need to drive in as many people because we're going to bring them in at the higher quality. But that is definitely a change in thinking when you're used to going, look at these numbers coming in, look at this response rate, or look at the volume we are getting. And that's what gets you going. It can be a disappointment when you start having to make that shift. So you have to make a mind shift as a team.
So you're saying that as you've targeted up market, your response rates are going down. Obviously, the net value acquired is going up, but the response rates are going down, and so that caught you off guard as you kind of go through.
Yeah, and I think your total volumes will go down too. And we talked about that before we went on this journey to look at free checking again. I just said, okay, this is going to be more expensive. There are going to be more expensive people to target. There's fewer of them. So supply and demand, they're just more expensive to target.
No, that makes sense. And of course, no other institution's going only after the rich people, so it makes it much easier, right?
Yeah.
I mean,
yeah, easy peasy.
Easy peasy. The second piece that we're observing has a really big impact on the cost of campaigns is the outreach response curve, is kind of what I talk about. If you look across the x-axis, the one on the bottom, this is the volume that you might target in a given market. The more I target as a marketer, the lower the response rate. So we've worked with some organizations that come in and it's like, well, we're trying to get to $10 billion in deposits, and we're used to seeing response rates of 65 basis points or more. And I'm like, how much are you getting? Well, we're getting $500 million in deposits, and it seems like you're not going to get to your goal if you if you don't target more. And as you target more, it's going to, the response rate's going to go down, which of course has a negative impact on CPA, not necessarily CPV, but certainly on CPA. Has that discussion come up at Synovus?
I think where this has come up for us, because we do look at that response rate across the markets, is what are we going to go after in that market? So probably one of the bigger things we've discussed related to this is which markets are doing well at the consumer and which are doing well at the small business, because there is a difference between our markets and which ones are successful. And that's based on different acquisitions and things like that have happened over the years. So that's where I've seen this conversation come up, is we need to have different approach in some of these markets.
That makes a ton of sense. One of the last two levers that you can pull is obviously incentives. And this is based on research that we did. I don't think it's any surprise. The larger the incentive, the more you get in terms of this. And we'll talk about the mix of incentives as we go through. One of the things that our research intended to identify was, hey, do incentives have a disproportionate disproportionate impact on different kinds of customers. And so we broke the customer base into rate sensitive shoppers, meaning customers that will jump for 10 basis points. Not surprisingly, they're very reactive to incentives. So making sure that there's some conditions out there so that you don't get the arbitrage of the offer is really important. But what's interesting to us is that the sticky non-shoppers and the loyal non-shoppers also see this. So incentives do attract customers who might not be in the market for a new relationship as we go through. It might be that they had an off conversation with their institution or something like that, and they get hit with that incentive offer, and you can knock them loose. But it's really important to understand that incentives drive some of the efficacy in the spend that we're spending on outreach, be it mailers, be it digital or whatever else. What has been your experience with incentives, Laura? Really easy to get through finance, I'm assuming. They love doing it.
We definitely lean into incentives. We focus on a few different things. So cash has been king for us. We have worked on, do we do interest rate? We've had some offers where we simply offered a financial plan, and that has played well in some of the more affluent space. But when we look at overall success, it's been cash. So then we ask ourselves, how are we going to structure this cash offer? So we may go out not just with one blanket cash offer, but we might be breaking it down into, for this first portion of that, you need to bring in this, but then we also, if you bring money market with a certain balance, we're going to do that. This second amount that you can be funded. We do have hoops that we expect them to go through, and because we value our Visa partnership and the marketing dollars they give us, a lot of times that might have to do with the debit card. So we can use Visa funding for the marketing. We do work very closely with finance, but also the product partners on what is going to be a good, profitable offer. We use Competi-Scan to look what's out there in the marketplace so that we have an understanding of the bearing. We're not always the leader out there in the market. So we're not necessarily competing with a Chase that's going out with maybe $1,500. We have done some rich ones, but maybe not quite that rich out there. And then I would say the other thing that comes along with the incentives and that you need to know getting into it is the increased overhead work that you have with it. So making sure they get paid. Are the bankers entering the codes? We spend a lot of time in discussions with risk about complaints and things like that, and their UDAP concerns. And so there are banks that aren't doing incentives, but for us, it really is at least that flag that gets the attention that can get you in the branch for us to have a conversation. And that's really what we want to be able to do, is have the conversation and show the advice side of this equation, which is really the product we sell as advice.
And then to validate everything that Laura just said, the data shows the same thing. What's really interesting is we look at incentives, is it does attract more affluent customers who are less likely to shop for checking accounts. So having some sort of incentive in there. And then obviously the amount of that incentive starts to make a difference as you look forward. The richer incentives obviously moving towards the Henrys and Henry, I did an acronym and I normally am very good. High earner, not rich yet, just for those that on the phone that may not have had that, and the affluent customers. What's interesting is that as we look at different types of customers, the affluent customers are more aware of it in TV and traditional media, as to where if we look at P2P and potentially the younger mass market customers, they're more aware in social media or friends. So again, being in different channels to make sure that incentive offer is aware is really, really important as we go through. One of the things that we had fun with is, okay, Hank and Laura, you did a great job explaining the drivers and all of those really great metrics that we got bored with for the first 15 minutes of this conversation. What does it mean, and how do I affect better outcomes against the metrics that I choose to use? And so what we did is take all of the data that you just saw and put it into a model and started to look at each dimension one step at a time. what does market density do to acquisition cost and CPA and ROMI and all those other things? What does the targeting do? So we'll go through it really quickly. I think that we're going to really focus in on incentives and onboarding, because I think those outcomes are kind of surprising. I know that when we had the conversation, Laura, you were surprised by some of how incentives play into the net metrics as we go through. So I'm going to go through the way to read these charts, and I apologize for the eye chart, but we wanted to, being Curinos, we had to give you the data, like we couldn't just do it on trust as we go through. The top left of this describes the scenario that we're running. So in this case, what we're comparing is dense markets to thin markets. So those are the graphs on the left and right. And then for every one of the scenarios that we're about to run, we'll show you media cost per acquired account. Well, this is showing pretty clearly dense markets are way cheaper to market to. No surprise there. I think we all knew that one as we go through. What's interesting, the other thing that we've done is the gray is the total campaign. The blue is the marginal, meaning how much per incremental over what you would have gotten if you did no marketing whatsoever am I paying per unit as we go through in terms of that. So dense is kind of interesting as we get into the ROMIs. Obviously, with a higher CPA, again, we're not changing anything else. So this is average targeting and everything else. I have pretty strong ROMIs. What this is really showing is that that marginal cost is really pushing down the ROMI as we go through, because I'm looking at that over fewer customers, fewer average customers. I don't think anything else on this page is really surprising, and that's why I simplified this. And we're going to go through the next couple pretty quickly as we go through. Easy for me to say. The second lever that we pulled was targeting, and this is saying, hey, are we targeting generic, meaning the average of those personas that we showed you earlier in the presentation? Are we going after a transaction mix, like with a transaction offer, meaning, hey, do 10 debit transactions? What's the mix of customers? That's going to lead to more P2P as we kind of go through, just tying the two thoughts together. Scenario 3 is that, hey, we're targeting for deposits. Bring us a deposit, recurring direct deposit of $2,500 a month or more. What does that do for us? And the last one is asking for a balance, which obviously customers have to have a balance in order for us to ask for it in terms of that. And this is where things start to get a little bit interesting. Obviously, as I go up the stream in value, and this goes to what Laura was saying before, I'm reducing the response rate, which is going to have a negative impact on CPA, right? Because fewer people are responding, but I did 1,000 mailers. I have to pay for all 1,000 mailers, but only 10 people responded. It's much more expensive than when I go after a transaction offer or a transaction set of customers where I put out an offer, 100 people respond, so it's going to be roughly 1/10 as much as we go through. So not surprisingly, it's getting more expensive as I get more targeted as we go through. Here's what's interesting as we kind of go through. Look at the ROMIs and the retained deposit dollars, cost per deposit dollar. It can be 30 to 50% lower per deposit dollar by doing that targeting, even though the CPA is higher. And these are the conversations that I think are really important to have in making some of these decisions. And to Laura's point, I think she said it really well. These are indicators to have the discussion to inform your decision. They are not to make the decision in of themselves. We will never do anything with a ROMI over X. I guarantee you'll do something with a ROMI over or below X because you need the deposit dollars or something else. Laura, is this true for you guys too? I mean, as you've kind of started to look through this feels like it kind of accurately displays your journey going from, total market to kind of focusing in on the affluent a little bit.
I think so, and I think just our journey overall in metrics, because CPA is something the marketer can measure on your own. Value, you have to have more voices around the table, and so it's figuring out that ratio between the CPA and the value is a really important part of the discussion. So this definitely, I think, aligns with what our experience has been.
Okay, and we got a question. What period of time? I'm assuming it's like, what period of time are we measuring these things in as we move forward? And so just for everybody's benefit, when we look at CPA, we're generally measuring accounts opened within 45 days of the drop, mail drop, or the digital or social outreach that we've gone through. Obviously, the cost per 180-day primary, we're out 180 days from when those accounts open. So it's 45 days plus 180 days as we go through. And the ROMI, we're looking at a 5-year ROMI is generally what we recommend, somewhere between a 3 and 5-year ROMI. In today's marketing cost, looking at a 1-year ROMI is just depressing, and so I wouldn't bother doing it as we go through. It is not a way to win friends and influence people in finance, for sure, as we go through. The next thing that we played with, and this one I think is also pretty intuitive, is just the outreach volume. Hey, if I target the best 100 customers in the market, I'm going to have a really low CPA because I've picked the best customers in the market. Every time I increase volume, I'm going to reduce or increase CPA. Even if you have the best model in the world, the more you increase volume. But I'm going to say this is the difference between targeting 100,000 customers and say 1 million customers. And this is an extreme example. There's not many folks on the phone that will drop a 1 million piece campaign. So some of this is theoretical. Is the difference in deposit and loan balances that I'm going after. If my budget is looking at growing by $14 million in a market, guess what, guys? Is that more important, or is your CPA more important? You're going to do these as trade-offs. So understanding those objectives are really important. You can see that obviously as I go out further on the volume, the ROMIs kind of go down too, again, because we're getting lower response. So the cost per acquired account and ultimately activated account is going up, but they're not super negative, and they're still contributing as we go through, depending on what the bank's objectives are. All right, now the fun one, incentives. Laura, you said this page shocked you when we went through it. Shocked is a strong word, but looking at this, what caught your eye and what got you kind of excited relative to what common wisdom is around incentives?
Well, when you think of incentives, I think a lot of people, you think back to like when we used to give a free toaster away. And so incentives, it's like, are we just falling into a sea of sameness of something that banks have just done because they've done it? So to see that it really does have an impact, I think was, we say it does, but sometimes you go, do we just do it to do it? So I think just overall, it was really nice to see that, the incentives that we're putting out in the marketplace are really important. And understanding what everyone else is offering incentive-wise is really important. And then I've been at a conference this week and learned that a lot of the banks aren't doing incentives, which shocked me a little bit to find out that some see it as a pretty risky behavior to be doing out in the marketplace. So yeah, I think it was just the overall, I think people love to dog us for our incentives sometimes, and why are you giving away money? So to be able to say, no, it works. It really does work. Felt good with this slide.
And I think it does make sense. I think that it is kind of an enabler of the marketing expense that you're going through. The neat thing about incentives, especially the well-structured ones that you've mentioned, requiring a deposit, requiring transactions, requiring balances, or whatever the value is that you're going after, it helps increase this 180-day primary number. And so as a result, the bank is going to realize the value of that. So it's much easier. If I knew that I was going to get a $200 account every time I made an offer, giving $200 for $280 a year ongoing, I do it pretty much all day long, right? Especially as we get up into affluent. By differentiating, though, is starting to say, hey, if the customer can give me this larger wallet, this larger activity, and you can kind of see this in some of the larger bank offers, I can actually go way up and get to $1,500 in incentives, because that average customer is bringing me $6,000 a year. Spending $1,500 to get an annuity of $6,000 a year makes total sense. And you can see it play out in the numbers. The ROMIs go up because we're getting more active customers. We're getting more pull through as we go through. And we're also doing slightly worse on the retained deposit dollar, and there's reasons for that, which with 5 minutes left, I'm gonna speed up so that we can get through the last piece of content. The last thing that we looked at is really onboarding and trying to drive more primacy as we go through. And this is another area where I think a lot of organizations are like, hey, I'm not going to spend my dollars on marketing, I'm going to spend it on primacy. Well, if I don't have new customers coming in the door, spending the money on primacy doesn't really, or onboarding doesn't really work. And it's one of those things, kind of like incentives, that work better when you're doing these campaigns. And so what we did is to say, hey, if I spent the effort to improve onboarding, and really what we're saying is activated accounts by 0, 3, 5, or 10%, what's the impact? And what you see is there's no impact on CPA, because the customer's in the door, it starts to improve, and you can kind of see it, the cost per 180-day primary and the cost per deposit dollar that I retained. And then as a result of that, the ROMI. Laura, you had some thoughts about this as we went through as well.
Yeah, we absolutely focus on onboarding, and we have probably about a month time frame we consider the onboarding, which is getting you activated with the account, getting their direct deposit, getting the e-statements. And then we go into the relationship deepening, where we're using some machine learning to target and get in front of people when it's right for them with the next best solution. I think one thing that's hard here to measure is my onboarding expense compared to my acquisition expense is probably more hidden in my MarTech stack. We've insourced a lot in this space. You know, we're using Salesforce Marketing Cloud. I have talent that's building these things internally. And so that would just be one of my questions in the future is, how do you look at some of those hard costs that you've invested in versus the variable acquisition costs that you have?
Right, but those fixed costs are paying dividends is the point. So yes, anytime that we can do it. We're going to take a breath. Just key takeaways, really think about CPA and why you're using it as you get through this. I think if you get nothing else out of this presentation, don't grade a campaign on CPA, because you may end up very upside down. And I think that understanding the difference between the objectives that you have versus the cost of things. Some organizations come to us and say, I need to acquire 50,000 members over the course of the year, because that's what we told our board that we're going to do. None of these measures matter, because the objective is to grow 50,000 people. And so the question really is, how do I do that the least inexpensive way possible, rather than trying to justify where we go through. Obviously, it wouldn't be a Curinos webinar. We bring the data that you've seen today. We have the data behind the scenes to help you find these customers. And believe it or not, I call it the Edison effect of Curinos, which is we've seen hundreds, if not thousands, of campaigns and programs put together to be able to help you guys understand the trade-offs that you're making and move some of these levers multiply. With that said, I'll open it up to questions. We just had the one. Hopefully we answered everybody's questions as we went through, but we really do appreciate your partnership and your time today and joining us. And Laura, thank you so much for taking time out of your day to join us here and bring your
Thank you for having me. Stretches my brain in a different way to think about all these numbers.
All right, well, with that said, strangely enough, there's no more questions. We wish everybody a great afternoon, and if you're in the Northeast, get ready for the snow and sleet. Otherwise, enjoy the sun.
Thank you, everybody.